Only 4% of businesses ever qualify for a $1 million line of credit, yet those who do grow 3.5 times faster than their competitors. What separates them isn't just revenue, it's a strategic approach most business owners never discover. How do traditional banks evaluate businesses for large lines of credit? Traditional banks use the 5 C's of credit: character, capacity, capital, collateral, and conditions. For a $1 million line, they'll scrutinize your personal credit score, typically requiring 720 plus for the primary business owner. They'll analyze your debt service coverage ratio, expecting 1.25 or higher, meaning your business generates 25% more cash than needed to cover all debt payments. Most importantly, they'll examine your business's track record, usually requiring 3-5 years of consistent profitability and revenue growth. But here's what most don't realize. Large national banks approve only about 13% of small business credit applications. Regional and community banks approve closer to 20%, making them potentially better targets for your application. How can you improve your chances before applying? Start by cleaning up your business credit profile. Establish dedicated business credit through a DUNS number and accounts with business credit bureaus like Experian Business and Equifax Business. Pay down existing debts to improve your debt-to-income ratio. Banks love to see ratios below 30%, which signals responsible financial management. Consider restructuring your business entity. CC corporations and established LLCs often receive better treatment than sole proprietorships. This separation between personal and business finances creates clearer boundaries that lenders prefer when extending large credit lines. What alternatives exist beyond traditional bank lines of credit? SBA-backed loans, particularly the 7 program, can provide up to $5 million. 0 cents with more flexible requirements than conventional bank financing. The government guarantee reduces the risk for lenders, increasing approval odds. Asset-based lending allows you to leverage your business's physical assets, inventory, or accounts receivable. With strong assets, you can secure credit lines that might exceed what your cash flow alone would qualify for. Private equity and venture debt providers offer another avenue, particularly for high-growth businesses. While they may take an equity stake or charge higher interest, they often move faster and approve larger amounts than traditional banks. What's the most overlooked strategy for securing larger credit lines? Banking relationships. Begin with smaller credit lines and systematically demonstrate responsible usage over 12-24 months. Banks are 4.3 times more likely to extend larger credit to existing customers with perfect payment histories. Meet quarterly with your banker to discuss your business growth and upcoming needs. This relationship-building approach can transform a standard $100,000, 0 cents line into a $1 million facility through planned increases. Because securing large business credit is directly connected to scaling operations, the next video reveals how to leverage your newly acquired credit line to qualify for a $5 million loan, including the specific financial ratios lenders require and the often overlooked documentation that increases approval rates by 70% for businesses seeking to make the jump from million to multi-million dollar financing.